Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
Welcome back to Navigating Retirement. I'm your host, Rick Durkee, and thank you for joining us again this week. Today, we're going to talk about, are you prepared, or how prepared are you to retire? In this podcast, I'll go over 3 of the 4 approaches to addressing long-term care and medical expenses in retirement. Don't worry, as always, I'll make sure and provide additional opportunities for you to pick up on the additional resources that we offer at the end of the show, so you can find out what that 4th approach to addressing long-term care and medical expenses in retirement is. But before we get started, remember to check the description in the notes below for any of the resources mentioned and your opportunity to learn more. Like, subscribe, and share our podcast, Navigating Retirement, with people that you love and care about. It'll provide them with information that they can make retirement decisions on. You can click on the link in the notes section below and find out more about resources that we offer for Social Security planning. Always, you can call and contact us for an initial 15-minute, no cost, no obligation consultation. Simply use the info now on your screen or in the notes section below. So let's get ready to roll here and see how prepared you are to retire. Let's find out what these 4 approaches to addressing long-term care and medical expenses in retirement are. So let's go over number 1 here together. Number 1 is traditional long-term care insurance. Now, my background is that I came out of the insurance industry before I started my firm, which is the Coastal Financial Planning Group. It was about age 45, and my wife and I were looking at taking out long-term care insurance that was offered by the insurance company that I was working for at that time. I actually qualified for a plan, and me and my wife took out a long-term care policy at age 45. It was a traditional long-term care policy. It paid for expenses if we had to go into a facility, be it a nursing home or an assisted living, or it would also pay for care in our home. The issue then was that we were thinking, well, we're 45 years old. We're probably not going to need this for a while, but actually long-term care is an expense that you may find yourself needing in your working lifetime also. So we do find that the statistics show us that long-term care is actually used by people that are not in retirement also. But we'd have made the decision to take out a traditional long-term care policy. And then about 5 years later, the industry was kind of, they were combining companies. They were making policy benefits less and less and less. And we decided to apply for another policy to supplement the policies that we had already at age 50. That's because I do feel that long-term care is one of the expenses that we have to combat in retirement for probably one of a husband and a wife situation in retirement. So we looked at another supplemental policy. I was actually declined at that time because of some health history. And so that's one of the reasons that people may not be able to take out traditional long-term care policies, is because their health has declined. And mine was a situation of an injury from a sports injury that stopped me, that they didn't know what it was causing some issues. But I'm over that now. I'm healthy. I'm turning 62 next year. And so let's fast forward from my age 45 to now the next option that you have in long-term care insurance, and that's to be self-insured. I decided then I couldn't get my supplemental coverage at age 50. My wife was able to. So she has traditional long-term care to be able to cover her expenses in retirement if she has a need and she can't perform 2 of the 6 activities of daily living. However, I then have to self-insure that supplemental part. And what I do with that is I just use some of my assets. Now, my assets in Could be the equity in my home. It could be other forms or streams of income that I have coming to me from Social Security or pension checks or self-directed pensions, annuity payments, things like that. Or I could just take it out of my retirement savings to pay it. Hopefully I won't need it. The problem is with traditional long-term care that I mentioned earlier is that if I don't use that policy that I have, I'm going to lose it. I'm not going to be able to carry any of those benefits forward or pass them on to my wife. If I don't use it, I lose it. And the premiums that I paid were basically shelled out of pocket, and I get no benefit for that. So maybe a combination plan, like I just discussed, a traditional long-term care insurance, if you're young enough to take one out, and then some self-insuring may be a plan for you. Now, there's a third way that you can cover your long-term care and expenses. But to be honest with you, this is the situation that we all really don't want in retirement. It's where we become a dependent. Now, we could become a dependent on our children or another relative, or maybe our spouse or something like that. But that means that that person or persons is going to have to take care of us for us. And we really don't want to be a burden on others in retirement. And so many of our clients here at the Coastal Financial Planning Group have decided that it's best to self-insure or do traditional long-term care planning to cover these needs. Now, there's many other ways to protect this potential expense in retirement. I'd like to encourage you to find out by getting our complete list that I referenced. You can visit on the link below the show notes here for a document titled 4 Approaches to Addressing Long-Term Care and Medical Expenses in Retirement. Listen, there's so many ways you can do this. The key is that you have a plan, a financial plan to protect this big risk in retirement. It's not about you so much as it is about who you leave behind. If you need coverage for long-term care and it takes a lot of the money out of the retirement funds that maybe you and your spouse were planning to share in retirement for both of your lifetimes, then I'm sure it's going to leave someone behind with a little bit less to have their lifestyle the way they might want it in retirement. That's all the time that we have for today. As always, you can contact us and set up your 15-minute complimentary consultation, and we'll conduct it in person, over the phone, or online. Stay tuned for our next episode of Navigating Retirement coming at you soon. Thanks for joining us today.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.